modeling. And over the weekend, I hope everybody got some time to do some homework or glancing through whatever been done. Because these courses, or you can say this workshop, it cannot be just one time attend. If you really want to master them, you have to practice, and practice will make you perfect. So please see that you do it, and I think that will help you. And sir is always there. We got the WhatsApp group, and you can, we are not going to continue that group, so that we give the hand holding to those who are people who are new fresh starters. The Excel is a tool which is widely used, as we were discussing, because sir is into valuation. So we were thinking we had an exclusive program on Excel for valuation for the members. As a discussion, I think we got a request from the members that it has to be online. So, but I had a plan to do it offline, physical. Okay, I think we noted it and we'll take into consideration. And thank you for your suggestion. Thank you for being there as a good. Now all your inputs will be value added to us. I think people, some of their numbers, WhatsApp numbers they're sending me. I'm putting my number to you on the web on the chat. Please note down my number so you can send your request on this 9321239994. Okay, please send your numbers to me so that whom do have any suggestion, or I can please include you in the group. Okay, thank you, friends. I think over to Mitesh to take off.
Thank you so much, ma'am. Thank you so much again. And thank you for all the coordination over the last 4 days, Yogesh, ma'am, and everyone at WRC. On that note, I'll just give you a refresher in terms of what we did last time. So we were essentially looking at financial modeling. We kind of broke it down into certain aspects. The first aspect was understanding the business model. The second was collating data. Third was eventually doing historical analysis, and fourth part, which is building the projections. So we already covered one model, which was the service entity case, which we covered. And last week, we also touched based upon a manufacturing case where we did the entire historical analysis and we were building the assumptions for forward-looking projections as well. So the agenda that I've planned for the day is that we'll spend about 1 hour 45 minutes or so doing the projections for the manufacturing entity. And I might extend the session today by about 15-20 minutes, or maybe half an hour, so that we can also cover a discussion on business valuation, the approaches, the methodologies, what goes into it, and so on and so forth. And the last day, which is tomorrow, will be completely focused on valuation, about 2 hours, 2 hours, 15 minutes, maybe 2.5 hours, wherein we'll be doing live valuations for certain exercises. We'll be doing income approach, market approach, and so on and so forth. Right. On that note, let us begin. Okay, so on that note, let us begin. If you guys remember, we were done with assumptions and we had closed down over here, which was closed last Wednesday. So we need to build in the projections today. So the sheets that we are covering today, I've made it a little concise to save time. So we are going to be making the projected revenue buildup. Then we'll be making the cost buildup. Then we'll be drawing down certain schedules with respect to working capital, asset, debt, and all of that. Lastly, we'll be focused on all three statements. So that's the plan for the first 1 hour 45 minutes. Let's begin. Coming to projected revenue. Now, remember that we are drawing it down for FY21, and then we are essentially drawing it down for the next 5 years. But while we draw it down for 21, there will be certain linkages which will come from the historical data. And from 22 onwards, we have the projected data available. So I'll just explain you what I'm trying to say when I solve the slide, and we'll get a hang of this. Now, with respect to Sedan, if I want to get to units sold for the next year, which is FY 2021, essentially in my assumption sheet, what I've built is that units volumes are going to increase by 3% for FY 21, 3% for 22, so on and so forth. So what I'm essentially trying to say is that my starting point would be the last data or input that is available as far as historicals are concerned. And from there on, I will be going and building the projections. So my suggestion is whenever we are building any of the projected sheets, draw down the equivalent sheet in the historical closer into your model so that you don't have to keep on referring to the previous sheet again and again. Okay. So like you don't have to keep on going back into the model. All right. On that note, I have historical revenue buildup. Under historical revenue buildup, can you see that sedan segment? We have about 35,000 units, which was sold last year in FY 2020. We are also saying that our assumption is that from next year onwards, the volume is going to see a growth of about 3%. So if I want to get to the projections for the first year, it's last year's number, which was 35,000, multiplied by 1 plus the growth. Where is the growth? The growth has been built into the assumption sheet. Brackets close, the center, and you have your volumes over here. All right. Now, for the next year onwards, the linkage can come in from FY 21 itself. So again, the same formula, last year's number multiplied by 1 plus growth. And now we can press Control R to get all our answers. Why I was not able to press Control R previously, because the linkages was coming from a previous sheet. So that's why we had to draw down the formula twice. One, to get to the number for 21, and second, to get to the number for 22. And from 22 onwards, we essentially have taken it forward. Yes, so you can absolutely go ahead and round the numbers off, and you can round it up if you want. No stress. Okay, I'm not doing that, but yes, you can go ahead and round it up. So to ensure that there are no decimals over there. Great point. Okay, now coming to prices, again, the same logic, whatever we applied with respect to volumes. So again, two linkages, one which will come from historical revenue buildup, and second which will come from the sheet itself. So prices for sedan, last prices which are available for us will be there in historical revenue buildup. Sedans were being sold at 3,50,000. Multiplying that by 1 plus the growth. And from next year onwards, we have the linkage here itself. So multiplied by 1 plus growth again. Control R, and we are done with our prices. Okay. I'm slightly going to maintain a little pace because I think we've covered all of this quite significantly. Whatever were the volumes in that year multiplied by price per unit. But since I want my final answer in crores, so I'm dividing it by 10 raised to 7. Something that we did for historical numbers. Once I have this formula built, I can simply press Control R and I get to my final answer, which is 1728. Now, whenever you build this, okay, just as a habit, just giving you certain tips in terms of what you should keep a look at. Once you build this entire revenue buildup, always have a habit of looking at what was the last number. Over here, my last number was 1225. Over here, my first number is 1312. And I've said that there's going to be certain amount of growth in volume than in price, and hence this number is closer. So what I'm trying to say is, if this number is not very close to, let's say 1225, let's say this number instead of 1312 was only 500 or 600, it should immediately strike you that there's something that's gone wrong. So always have a habit of checking what the last number was and try and see what's happening over here. If it is going fine with the story that you have built, then great. If it hasn't, go and check if there is any error in the form. All right. Control R, and you should get all your answers up till 1728. The logic remains the same for hatchback and SUVs. So I would want you guys to close down on hatchback as well as SUV. Okay, quickly. In case if someone is still lagging behind as far as speed is concerned, then you can just follow my pace. So units sold again. Just ensure that you're linking hatchback to hatchback. Okay, there could be some error in doing that, so just ensure that. So just keep on checking whether your answers are matching with mine. In case if I make an error, please let me know. Okay, I'm done with hatchback. It's going from 1329 to 1618, and historically hatchback was at 1265, so it should be fine. Moving on to SUVs. So these are my answers with respect to SUVs. So they move from 550 to 944. And historically, my number is standing at 480. So no stress. It's looking fine. I can just quickly total all these up to get to the firm level revenue. And again, compare it with historical firm level revenue, which was at about 2,970 crores. I'm saying projections is looking at 3,190. Again, very much in line and range. So things look fine. Thank you, ma'am. Right. I would just want all of you guys to check your answers, please. And at the same time, let's also draw down something called as the revenue mix, which we had spoken about, to understand whether our story is making sense or not. To get to revenue mix, sedan's revenue will be divided by total revenue. Similarly for hatchback and SUV as well. So now if you see, let's go and see what is happening historically first. We were saying that sedan and hatchbacks, although they were popular in the past, they might not see the same amount of popularity in the future, and SUVs were picking up steam. And if you actually see the story for the future also, the market share, or sorry, the share in terms of revenue or the revenue mix for SUVs has increased from 17 to 22 in our own entity revenue mix dynamics itself. And sedan has dropped down by a certain percent, whereas hatchback has gone down, this is exactly something which has actually happened in the Indian market also. So this seems absolutely fine. This is also matching with our story. So once you are done building the entire revenue, ensure that you are doing a story check also in terms of company's goals, industry trends, and historical trends. So this will help you achieve a lot of stability even while you are documenting all of this. All these working papers will give you, or your analysis will get a lot of strength on account of this. So I hope everyone's pretty clear in terms of what all we are doing. We discussed a lot while doing historical analysis, certain aspects while keeping check while we are drawing down the projections also. I'm guessing all of you are done up till here. So we can move ahead to cost buildup, because I already got certain answers that the numbers are matching. So that's fabulous. Moving to cost buildup. Okay, I'll just spend 30 more seconds just in case if someone's not done. Okay, Deepa, sure, thanks. So moving to cost buildup. We're going to come down to cost buildup, please. Okay. So we've got the raw material prices, which we first need to figure out for the future. Post that, we need to figure out what's the consumption that's going to happen, which is for each of the segments. And once you're done with that, with respect to all other costs, all other operating costs, so up till EBITDA, everything's given over there as well. Now, we've not been given any information with respect to units manufactured. So we might have to go down with the easier assumption of taking them on units sold. But in real life, whenever you're making a financial model, you'll have to go and build whatever your costs are on units manufactured. So I'm doing this only from a simplicity case perspective over here. But whenever you're drawing down a financial model, you'll always use units produced and not units sold. Okay. Now coming to the projected revenue buildup that we just have drawn. We have units sold for all entities, which is sedans, hatchbacks, and SUVs. In our assumption sheet, if I come up, I also have what is the raw material requirement. And in my assumption sheet, I also have what is going to happen with respect to raw material prices. So what do we have to do in cost buildup? Now, if you remember correctly, historically also when we were during the historical analysis, when we were trying to build the cost buildup, it was a combination of three aspects, right? Units manufactured. We multiplied that by the volume conversion matrix. Multiply that by raw material prices. That's exactly the same thing we are going to be doing over here, except as I told you, since we do not have information with respect to units manufactured, for simplicity, we are using units sold. But in all real life scenarios, you'll be using manufactured one. All right. So now coming to units sold, we'll first pick up the units sold from projected revenue buildup. The next thing that we need is raw material prices. We don't have those. We first have to build it. And then the next thing that we'll need is the conversion matrix that's given over here. Okay. So let's first build in the raw material prices. Yeah. Also, I'm just putting historical revenue buildup back to its place. And I'll get cost buildup over here. To get to prices, I'll first need last year's price. I have steel cup price over here for 2020, historical cost buildup. Multiply that by 1 plus growth. Where is the growth number lying? The growth number is lying in my assumption sheet. All right. For next year onwards, last year's number multiplied by 1 plus growth. So no rocket science. Again, the same thing. Control R. In fact, I think we should be able to use Control D also over here. And let's just check whether these prices are matching or not. Okay. So with aluminum, historically we were at 131. It's going to 141. For plastic, we're at 60, 63. I think most of it seems in line. So I think we can be rest assured that these numbers seem fine. Okay. So I just built it for steel and I selected the entire array, pressed Control D to get all my answers. So these are my prices. These are my expected prices for the future. Now I need the actual consumption. So I will build in the formula. I'll pick up the projected revenue. From the projected revenue buildup, I'll pick up the units sold. Sorry. Units sold will get multiplied with whatever is the volume conversion for that segment. That will get multiplied with the price with respect to that raw material. Now remember, with respect to the revenue side of the story, we'll have to freeze the row because row 8 with respect to revenue would remain the same as far as volumes are concerned, but the years would change. For the years to change, we are keeping column C open and we are locking row 8. Okay, once I'm done with that, I want my final answer in INR crores. So I'm also going to divide this entire formula by 10 raised to 7. I press enter. I get my answer with respect to steel. Control R, Control D. I get all my answers. Okay. Once I've reached up till here, I'll just press auto sum. And at the same time, also do a checkup in terms of if there's any error. So historically, our consumption for steel was at 261. We are saying projected, it's looking like 296. Let's say paint we were at 65. We're looking at 73. Right. So more or less seems in line. Sure, Arpit, I'll explain this entire thing again. No stress. So what I was trying to, I'll build this again for everyone who haven't understood. For everyone who's understood it, you can go ahead to the next segment. Okay. So what we are doing over here is that we are trying to get to raw material consumption. How would we get to raw material consumption? There are 3 factors or 3 underlying drivers with respect to this. First, you will need units manufactured. We don't have this. There is no information with respect to this. So that's why you're using units sold. So units manufactured would be the first one. Multiplied that by the volume conversion, which basically means that how much quantum of a particular raw material is required to build 1 unit of that product, multiplied by the raw material price. Once we figured these 3 variables, we just convert this answer into INR price. Okay. Now, since we don't have units manufactured, I'm using units sold for simplicity over here. Volume conversion has already been drawn down in the assumption sheet, and raw material price is something that we drew down here. Now, how do we get to the formula and everything? So just please look on your screens. So we first start with the volumes. We have 36,050 units of sedan. We need to multiply this by volume conversion, which is lying in the assumption. We need about 1600 kilos of steel. So this is the total requirement, volumes multiplied by 1600 kgs. Multiplied by what's the price per kg with respect to steel in that year? It's going to be 51. So I'm multiplying this by 51. I want my answer in INR crores. So I'm going to divide this entire formula by 10 raised to 7. But since the volumes are going to remain the same for every raw material, whether we are using steel, aluminum, plastic, rubber, glass, or paint, I'm going to freeze the row with respect to the volumes. And I'm going to keep the column open. What will happen with this is when I keep the column open, the years will change, but row 8 will remain freezed. So I'll constantly keep on getting the volumes with respect to that particular segment. Enter. Control R will give me the same formula in the row. Control D will give me entire formula for the columns. And I'm done with my entire table. To remove formatting, you can just use Alt HPN. And to get to formatting, you can just get to Alt HPS, which will help you with. Okay, auto sum, and you have all your answers. For removing the formatting, Alt HPN, and for getting to the formatting, like if you want the full box, then Alt HPS. Okay, so we're done with sedan. Same logic will now be followed for hatchback and for SUVs. So I want you guys to go ahead and build it on your own. Do not start with this. You might just end up making an error. So do not start with other costs. Just close it up till row 64. All right. And then we'll just keep a tab and we'll check our answers whether they match or not. Okay. So moving on quickly. Now for hatchback. Now raw material prices, the best part is once you've drawn down the prices, they are not going to change. So you can just simply link it from the sedan segment. You don't need to build this again. Now coming to the consumption story, here is where you have to build the formula. So now I'll go and pick up the units for hatchback. The conversion for hatchback could be different, so ensure that you're tying up with hatchback. Okay. Multiply that by the prices. Divide by 10 raised to 7 because you want the answer in INR crores. F4 for freezing the row with respect to volumes for hatchback. Enter. Control R. Control D. Alt equal to. Enter. Control R. Okay, I hope you guys are using your keyboard as much as possible. That increases the speed exponentially. So whenever you're doing financial modeling, try and ensure that you're using your mouse to its least possible extent. Okay, again, let's just keep a check in terms of overall raw material for hatchback. So now what's happening is that the consumption is actually from 555, it's gone down to 509. So what could be the reason with respect to that is something that you'll have to check. What is happening is under projected cost buildup, you'll have to go and check with respect to each and every line item. Your steel consumption from 261, it's gone down to 240. So maybe the units that we are utilizing for the historical numbers, which are units manufactured, are more than the units which are sold in our projections. And because of that specific reason, and also there's not a very major uptick. The assumption is only 1%, a growth of only 1%. That is why it's leading to a lower number as far as projected cost buildup is concerned. So your answer seems fine. It moves from 509 in 2021 to 617 in 2025. Again, the same logic gets followed with SUVs. Prices you can just pick up from an earlier segment because they are not going to change. And now you can start drawing down the raw material consumption. Again, instead of manufactured, because you don't have that information, we'll have to rely on sold. Multiplied by the volume conversion for SUVs. Multiplied by the raw material price. Divide by 10 raised to 7, freezing the row with respect to volumes. Control R, Control T, Alt equal to Control R. 216. Historically, we were at sorry, my bad. Historically, we were at 187. If you guys have reached up till here, just please check your answers. getting to the total raw material consumption. 630 plus 509 plus 216. And overall, again, I would like to check it with what's happened in the past. I was at 1234, starting at 1355, closing it at 1937. So these are my numbers, guys. Just in case if I have done some error or if your workings are slightly different than mine, please let me know. But this is where I am at row 64. In case if you have reached row 64, your answers are matching, just type in yes. In case if you want me to explain something, just please put in your query. Fantastic. Just loving the speed. Okay, super. All right. Great. So for the last bit, up till now, I think we've been doing last year's number multiplied by 1 plus growth. You need maybe 100%. But for the other costs, remember the assumption that we built. Let me first come down to the assumption so that it's very clear. The assumption that has been built, remember, it's other costs as a percentage of revenue. All right. So it's not year-on-year growth. These numbers are not your year-on-year growth numbers. They are as a percentage of total revenue. Okay. So keep this in mind. In case you've already done and if you've taken a year-on-year growth, please change your answers because it's not year-on-year growth. These are percentages on the total revenue. Where will I get total revenue from? We've just built the total revenue and projected revenue buildup in row 41. So you could use those linkages. On that, apply the respective percentages and you'll get your answer with respect to all the costs. Okay. In the meanwhile, let me just shift the historical cost buildup. So I've got my revenue. I'm simply going to multiply this by the assumption that I have for other expenses. I will also ensure that I'm pressing F4 and I'm freezing the row with respect to revenue. Press enter, Control R, Control D, and I should have all my answers. Okay. So that brings a close to the cost buildup. Now we can draw down the easiest sheet in the model, which is drawing down the P&L up till EBITDA, which is what we generally do. If all of you are done and you answer the matching with mine, we just got cost buildup. If I can just have one more, okay, please. Sorry, I keep on doing this just to understand where you guys are, and in case I need to explain a concept again. Great, fantastic. All right, thank you guys. Okay, so let's move to the first statement, which is projected P&L, the easiest sheet. So up till EBITDA, I'm not even going to explain. I think you can start drawing down your answers quickly. So once we are done with revenue buildup and cost buildup, you remember we draw down P&L up till EBITDA. That's how we make our models. So from revenue, from operations, let's pick this up from projected revenue buildup. Year-on-year growth, current year divided by previous year -1. This could be used for your analysis perspective, and if you want CAGR, sure, ma'am, sure. These are my numbers with respect to other expenses. Okay. Getting back to the P&L. So everything that we've just done up till now. Oh yes, Jigar sir, you could use RRI formula for CAGR. That's fine, no issues. Coming to raw materials consumed up till EBITDA. So we've drawn down each and every cost line item and projected cost buildup. So I can get my raw materials consumed. And now I need my other expenses. So Control R, and now I think I can just do Control D up till selling and distribution, and I will have all my answers. Now coming to total operating expenditure, I'm just going to take all expenses, Control R. To get to EBITDA, it's going to be revenue from operations minus operating expenditure. I'm at EBITDA. Now, certain checks. Try and see what is expected out of the industry CAGR. If let's say that the industry overall CAGR is expected only to be 2%, and we are at about 8, hypothetically is what I'm saying, and we are at about 8% over here, then you might want to go and check what's happening with the assumptions, what's happening with the story. You might want to redraw the assumptions, right? Let's say the industry is expected to grow at 15% and you're still at about 8%, then slightly pessimistic. Then you should try and identify what are the challenges. Why do you envisage such a tepid growth when industry is expected to grow at about 15? All right. So one check. Another check. There are two checks which will happen at the EBITDA margins level. The first check that will happen is historically, has the entity ever achieved these kind of numbers? And for projections or from the industry perspective, has any other peer achieved any of these numbers? All right. If these numbers don't look realistic and these have neither been achieved historically in the past by your own entity or by anyone in the industry, please question, redraw assumptions. Okay. So certain checks at the macro level. Now, once you're done up till EBITDA, the next thing that we do with respect to modeling is we don't worry about the P&L for a minute. We move towards the balance sheet side of things and we start with the working capital. Correct? That's exactly what we're going to do now. So let's go down and build the working capital. For drawing down the working capital, we have already made certain assumptions. For the assumptions, we have factored in number of days for each of these line items. And remember that we factored all of these numbers on revenue. So whatever computation is going to happen on the projected revenue, right? So keep that in mind. So just follow my lead for a bit, just for let's say accounts receivable, and you should be able to get the rest. So if I want to figure out accounts receivable, let's say for 2021, then essentially I'm going to be using my revenue for 21 multiplied by number of days that I've put into assumptions for 21 divided by 365, and I should get my answer. I can also freeze the row with respect to revenue because I know that I have inventory down below. Control R, Control D should get me inventory also. Don't press Control D up till total current assets, simply because we have something called as cash and cash equivalents, each month, and we haven't drawn down cash and cash equivalents over there. So my suggestion is either you can do it individually or just draw it down up till inventory. All right, and other current assets will have to be built in separately. So for everyone who hasn't understood, I'm drawing down other current assets. Pick up the revenue from P&L, multiply that by number of days that we plugged in for other current assets for the assumptions, divide by 365, Control R, you should have all your answers. Okay. Now we don't have cash. Don't worry about cash for the time being, but sum up the other current assets because there's nothing else. As far as cash is concerned, this will flow from cash flow. So once you're done with cash flow, the final resultant answer will be plugged in over here to check whether our balance sheet matches or not. Okay. So don't worry about cash. Just draw down the final answer for total current assets and you should reach here. The same logic will get applied for liabilities also. We have accounts payable and current liabilities. So drawing it down again for anyone who's still not understood. Simply press Control D for other current liabilities, and I can total these up to get to current liabilities. Yes, Kusum, so if you remember, we discussed this last time that since I'm doing modeling, I'm not really bothered about what the denominator is, and that's why for working capital, I have assumed revenue as a base. You can always go ahead and not only current liabilities, but even other current assets or inventory could be separately built. Inventory could be built on COGS. Other current assets could be on that particular aspect, which is covering and not revenue. But from a simplification point, when you're making financial models, if we get everything exactly, so if not, it's not about it's based on assumptions. It's that historical analysis was also done on revenue. So going forward, also we are taking it on revenue to ensure that we can ensure and press Control R, Control D everywhere. Otherwise, we'll have to keep on digging out that particular variable, which would be the underlying. So, and in case if you want, you can actually try and build all of these on liabilities also, and you'll see that your answers will match with mine. So no stress. Yes. So we are done with assets and we're done with current liabilities, which basically means that we are done with the following in the model. Assumptions we did last time, revenue we are done, costs we are done. In the P&L we are done up till EBITDA. And we are also done with working capital schedule. The next thing that we do after this is we try and factor in the asset schedule and depreciation. So let's get on to asset schedule. Come to assumption sheet, please. Under the heading of capital expenditure and depreciation assumptions, we have drawn down certain assumptions. So we are saying that FA turnover ratio is expected to be 2.15. All right. So if FA turnover ratio is expected to be FATOR is expected to be 2.15, what is the FATOR? It's revenue by fixed assets. I already have factored in FATOR, which is 2.15. I also have my revenue, all right, projected. I want to find out what my fixed assets are. A simple cross multiplication will help me figure out my fixed assets as far as closing is concerned. Okay. So essentially my fixed asset would be nothing but whatever is my projected revenue divided by 2.15 will be my fixed assets. I hope everyone's got this. So let's get to fixed assets closing. Projected revenue, either you can pick it up from P&L or the revenue buildup divided by your fixed asset turnover ratio. So this becomes my closing. Now I have closing. The next thing that I can find out is depreciation, which I've assumed on closing net block. Ideally, you can take depreciation on opening and additions. We've assumed we are going the reverse way, so we've taken dep on closing, but in all likelihood, you can take in on additions as well as the opening. All right. In either scenario, you can build up the math, so that's not a challenge. I'm taking I have my dep, I have my closing. Can I get to opening? Whatever was my last year's closing, which I can pick up from the balance sheet. Whatever my last year's closing will become this year's opening. So I have opening, I have depreciation, I have closing. Now remember, I told you one thing, unless and until there's anything specific given to you by the management, that they are going to be selling off a particular asset or they're going to be hiving off a particular asset. Do not take any deletions into account. Also, there's no information with respect to deletions in this case. You can simply press Control minus and I'll be left with additions. Please focus for a bit. Opening plus additions. All right. Opening plus additions minus depreciation should get me to closing. I have opening, I have depreciation, I have closing. Can I get two additions? So additions essentially would be closing plus depreciation minus opening. I apply that over here. And I get my additions. Now, whatever was my last year's closing with respect to the net block, let's say obviously it's going to be next year's opening. So I can just link it, press Control R. I have my depreciation, I have my closing. So for additions also, I can simply press Control R. This gives me my entire capex movement and my depreciation for projections. I hope you guys have understood this. All right. So for depreciation, I've taken the assumption on closing net block because that was given on the case. Or alternatively, you can start with opening plus additions and then build a depreciation percentage on that, depending upon what your case is. Okay. Now this essentially, once we're done with the entire capex and the depreciation bit, there are two aspects that get covered. From the balance sheet perspective, we are done with the fixed assets, closing. And from the P&L perspective, we had reached up till EBITDA. So now we've got our depreciation. So what we'll do is let's link our depreciation. Okay. So depreciation, I'll link it in the P&L. If I have depreciation and I have EBITDA, EBITDA minus depreciation, I'll get to EBIT. And in the balance sheet, I can draw down my fixed assets, which is nothing but the closing fixed assets. Okay. So now we're done with asset schedule as well, and we factored in depreciation and the net block. So the next thing in P&L, now we're not only done up till EBITDA, but we're done up till EBITDA. So what's left now? Interest. So what we essentially do is we draw down something called as the debt schedule now. Again, this will also cover in two things. It will cover the debt or the non-current liability component for the balance sheet and the interest / finance cost component of the P&L. So let's draw this down now. So come to assumptions. Come down to row 117. We have something called as debt related assumptions. And under those debt related assumptions, we have something called as proceeds from long-term borrowings and short-term borrowings, and then whatever is the principal repayment. Now let me go and read what the case says. If I come down to the last bit, it says that the company intends to pay off its debt obligation and has a long-term plan of going debt-free, subject to availability of cash flows. Debt repayment can be assumed as follows. Long-term borrowings at about 50 crores per year and short-term borrowings at 25 crores a year. And lastly, for the interest covenants, they've said that the interest rates are expected to be the same as historical. So what they're saying is that from the perspective of cash flow, you'll have to analyze this. First, draw down your cash flow and try and figure out whether you have surplus or deficit. If you have a surplus, then please go ahead and ensure that in projections, this entity becomes debt free. How you can proceed doing this is from the long-term perspective, you keep on repaying 50 crores every year. And from a short-term perspective, do this at about 25 odd crores. Now this 50 and 25 odd crores, obviously a total of 75 subject to availability of cash flow. There's also something called as proceeds from long-term and proceeds from short-term over here in the first two rows. Now, technically, we cannot build either of these line items. We cannot build them because as of now, we don't know what the cash component is. So maybe what we'll do is, for the time being, let's just put 0, 0 everywhere. And let's get the linkages done. And once we are done with the cash flow, and when we are in a better position to analyze, we'll try and see how much debt needs to be repaid. The logic of doing the linkages right now is that the entire model will be linked, and whatever repayment that you're plugging in that year will still give you a tallied model at that point in time. So you don't have to come back again and then do the linkages. So now for the time being, assuming that everything's 0, we can just go ahead and do the linkages. And the reality of the situation can be factored in once we assess the cash flow situation. So let's start. Let's start building long-term borrowings. Okay. So we had, let's go to historical balance sheet. We had long-term borrowings. Last year's closing will become this year's opening. Plus, let's go to the assumption sheet. Whatever additions that you are making in your long-term borrowings minus whatever repayments you're making in your long-term borrowings. That essentially should give you your answer with respect to the closing of long-term borrowings for that. For next year onwards, current year number, which is FY21. So it's a previous year number, which is FY21 plus, again, the same logic. Addition of proceeds, subtraction of payments. Now I can simply press Ctrl R. Obviously, the answer as of now is going to remain 497 because we've not punched in any values. Once we are done with cash flow and we punch in values, these answers will automatically change. Same concept will be followed for short term also. Proceeds added, repayment subtracted. Next year onwards, last year's number plus proceeds added, repayment subtracted. I'll simply total this up and keep this ready. And I also have my total debt now. And in my assumptions, I've also built in the interest component as a percentage of closing debt at 12%. Can I now draw down the interest number? Yes, I can. It's 12% multiplied by whatever is my closing debt. I can simply press Ctrl R. As of now, this number will remain the same because my debt is remaining the same and interest rates are the same. In the meanwhile, also draw down the EBIT margins. So from the P&L perspective, going back to where we are in the model, we're done with the debt schedule, the interest and finance cost. So essentially now all we need to build is the tax. Okay. And once we are done with the tax, let's try and close the BS and cash flow. And let us see if the entire model is in a working flow. coming to PBT, if I have EBIT and I have interest costs, I can simply subtract. And I'm going to build in the same formula that we built for historicals also. If it's less than 0, then 0. Otherwise, whatever is my profitability multiplied by my tax rate. I have my taxes as well. PBT minus tax gets me to PAT. And lastly, I'll close by drawing down the PAT margins. Again, two kinds of checks: industry level, entity level. Historical data points. Why am I saying this is because I'm seeing a lot of reports where, especially for startups and SMEs, and crazy numbers as far as valuations are concerned. And forward-looking PAT margins are nowhere in line with what has been achieved historically or something that has been achieved by anyone in the industry. So all these, maybe for the time being when you're building, maybe you've not paid a lot of heed to it, but there's a high chance that when certain questions will come in from the regulatory bodies, it will get very, very difficult for you to defend. All right. For interest calculations, we've just done interest on debt. We've already drawn down the interest percentage in the assumption sheet. We drew down the debt. Debt multiplied by interest percent will get you to the interest cost. So this is where we are. The P&L side of the story is built. In the balance sheet, we've majorly built everything except for equity and reserves, which is what we build now. And then we'll draw down the cash flow and try and close whether the model, whether we get a tallied version of the model or not. Now, there's no information of any raising of funds or new cap, any infusion. If there was any infusion which is coming in, then you would have simply drawn down what the equity infusion is coming, and you would plug this over here in whichever year that equity infusion was coming. So coming to equity share cap, I will simply pick it up from last year's number. Since there's no information with respect to infusion, I can simply assume the same numbers. For reserves, whatever was my last year's number as far as reserves are concerned, plus whatever I'm making this year. I'm assuming that there is no dividend, also there's no information with respect to the dividend in the case. So I'm assuming that whatever PAT has been drawn down has been retained back to the business. Wait for the next year, you can simply press Ctrl R. Total these up, and you're done with all the line items in your balance sheet, except for one, which is cash. So the last thing for the model that we'll focus now on is going to be the cash flow. For everyone who's not done up till here, I'll just leave you with 30 seconds so that you guys can pick up pace in case if you haven't. In case if you have, great. I would suggest you can move on to the cash flow. The format is ready and available to you. You can start building the cash flow. For everyone who's still solving this, I'm just going to keep the balance sheet tab open for about 30 seconds for you to check your answers. So Kusuma, we've actually totaled it, but whatever change that comes in, right, will be built in accordingly. So you can go ahead and total it. That's not a problem, because totaling will just help you with ensuring whether the balance sheet is tallying or not, irrespective of whatever drawing down you're doing with respect to long term or short term. All right. So so you can total it. In fact, even I've totaled it. So I can go ahead and I'll do that for you. So and I'll do it for the asset side also. So basically what we're saying is this check number is what we should ideally be deriving in our cash flow. If we don't get the same answer, that means we made some error in the model somewhere and we might have to look it up. Okay. Okay, so what I'm doing now is I'm going to start building up the cash flow. Let's start with 21 net profit before tax. So the adjustment that I'm making for debt, the adjustment that I'm making for interest. Sorry, my bad. Adding back depreciation and interest to get to operating profit before working capital changes. The assets total is over here. We still need to draw down the cash and cash equivalent, so your assets might not match. All right. So hold. Okay, now coming to the working capital changes, you might want to bring down your historical balance sheet closer for this one, closer to the projected balance sheet. For the first year, you pick up the accounts receivable from the projected balance sheet minus the historical number. For next year, you just refer to the projected balance sheet, current year minus previous year, and you're done. Control R, you'll get your changes for all years. For inventory, again the same logic. Same logic again for other current assets also. The logic follows for payables and current liabilities as well. And now getting to cash generated from operations. So what I'm going to do is I'm going to start with operating profit before working capital changes. I'm going to subtract all the additions in current assets. And I'm going to add all the increase in current liabilities. Yeah, so Jigar sir, I'm doing it at the entire level, like I'm doing it at the current liabilities and asset level. Because I've plugged in the increases for assets. So all total assets, I've taken it as a subtraction sign in my total formula over there. And for increase in liabilities, I'm adding it. Please check your answers with respect to your cash generated from operations. In case if you're getting the same answer, please type in OK. Also remember at this point in time, as I told you again and again, that in the previous class, that cash flow is very, very critical. If you are getting cash generated from operations in an incremental forecast, it essentially means a very, very good sign from a going concern perspective. All right, which is what is happening over here. In fact, it's slightly incremental every year, which is also sometimes the sign of a very, very stable business. All right. So once I have cash generated from operations, I can get to income taxes paid. I'm assuming everything's been paid. So my net CFO is moving from 398 crores to 462 crores. I hope you guys are done up till here. Can I move forward? Okay, sure. Now coming to the capex. So there's either sale, disposal, or any additional investment. So there's no factor or there's no input assumption with respect to disposal of assets or selling of any asset. Getting this out of the picture, coming to capex, I can simply log on to the assumption sheet. And in the assumption sheet, I had built in something called as additions. Those additions are nothing but equivalent to my capital expenditure. Since this is cash moving out, I'm just putting a minus sign and getting my cash flow from investing activities. Now, there's no information with respect to equity. Otherwise, we would have plugged in equity also. We would have plugged in dividends and so on and so forth. I've just, for the time being, simply plugged in long-term, short-term borrowings because we've drawn down a schedule for that. So again, we still don't know what the scenario is. So let's just simply link the additions from the assumption sheet. I'm simply linking the additions from the assumption sheet. And I'm also going to link the repayments as well. Once I draw down my cash flow and I'll see what the scenario is, maybe we'll try and plug certain assumptions in the assumption sheet. The covenants which are given in the case, 50 and 25 crores for long term and short term, and then we'll see what happens. Interest paid, I can simply plug it from the top. And for the time being, let me just build the formula. So all the proceeds will be added, the repayments and interest costs being subtracted. So Shilpa, at financing activities. So let me just close this and then maybe I'll get back to operating activities. So I think we're done with financing activities, we're done with investing, we're done with operational. Essentially what we need to do is we just need to add all three together to get to cash flow for the year. So we have a negative 44 number, and then we have 7765, and then going up to 52. So that's the net cash which has been generated throughout the year. But even apart from net cash which has been generated during the year, we also have cash lying in our books. So from, I think I have the historical balance sheet here only. So my last year's cash number will become this year's opening. So I have cash which is getting plugged from historical balance sheet. Whatever I had as my starting point, which is 406, plus whatever I generated, when I add them, I'll get my closing. Closing for this year should become opening for next. Control R, and I'll get all my answers. Now these answers, which is cash and cash equivalent at the end of the period, this needs to be plugged into the balance sheet. To check whether there's any error in the model or not. If our check answers are sorted, which they are, which means that our model is good to go. Now let's focus. Yes, Ankit. So that's what I'm doing right now. I'm just explaining that in that context for both debt and equity. I'll do that. All right. So let me just first cover Shilpa ma'am's question of cash generated from operations, and I'll come back to debt and equity. So now coming to cash flow from operations, essentially what I've done is whatever is my operating profit before working capital changes, I've subtracted any and every increase in asset, because whenever I'm doing any increase in asset, it's money which is getting blocked into working capital. So it's cash flow negative. And whenever there's an increase in liability, it's money which is not being paid, which means the money is staying back into the system, which means it's positive from a cash flow perspective. So I'm adding all of those. So all my current assets, the changes have been subtracted. All my current liabilities, the changes have been added. And as a result, I get my final answer. That's how I get to my cash flow from operations. I hope that answers your question. Now coming to the final resultant answer, which I think Ankit also has a question over here in terms of equity and debt. Now let's say this is my end total, right? This is the number that I have. Now if I'm looking at any model, essentially I should be looking at what's the bare minimum cash balance required. So what I can do is I can figure this out. Maybe I can have a discussion with the management in terms of what's the minimum cash balance that I would want to keep. Correct. 362 represents surplus in cash. Absolutely correct. So what I can do is I can try and first figure out what's the minimum cash balance that's required. Like how would I essentially compute this? I would go and factor in my OPEX. And in my OPEX, let's say, I will say that whatever is my 2 or 3 months worth of OPEX. Just in case if there's a calamity or during COVID, things were shut for 2 months, 3 months, still had to make certain payments. So let's say I'm going to use 2 months for simplicity's sake. So I go to projected P&L, pick up my OPEX. Also, I'm still taking an overall OPEX. You might not even need to take the raw materials which are consumed. Okay. But let's say from a contingency perspective, I'm even building that. So let's say this number comes to 449. Then in that case, this 362 doesn't suffice. But if I remove even raw material consumed, which will purely give me my running expenditure, let's say, I'm just taking these 3. So then I'm saying that I'll need about 117 as far as my cash requirement is concerned. So then I'm still at a surplus of this number minus this number. Okay. So you can draw down whatever variations that you want to build depending on whatever is the practice at that particular entity. But the point that I'm trying to make over here is, once you're looking at these numbers, if these numbers or if these cash flows are positive in nature, that means you are at surplus. If these numbers were negative, you would be at a deficit. In a scenario of surplus, you don't have to worry. You have two remedies at your play. First is make the repayments with respect to debt. Since you have excess money, you can look at options like dividends, buyouts, or buybacks. So these are certain various options which are available in case if you have surplus cash. Why does TCS or Infosys keep on announcing buybacks twice in a year? The same logic. Excess cash generated, they don't have an avenue where this can be plugged in. So it might as well distribute it. All right. Yeah, so 362 can represent even investments. Obviously, I would put in. So Amolji, that advance from customers will be already impacted in working capital. So we don't really have to worry about that. So the idea is that this entire scenario will get factored in. Yes. Obviously, no one is going to keep this in current account, right? It doesn't make sense. You will put it into liquid instruments. But what essentially I'm trying to say is when we say cash, it's cash and cash equivalents. So short-term investments, let's say, are covered with. Okay. Now, if you have a deficit in your model, then there's a challenge. But you still have two options. Either you'll have to plug in equity or you'll have to plug in debt. So this is what happens in any startup, right? Whenever they are raising funds, what is happening is that cash flow from operations is negative. Investment anyways negative ही होता है. तो क्या करना पड़ता है? Because both sides of the cash flow are negative, financing से positive लाना पड़ता है. And that is why series A, B, C, D, E, F, whatever, right? And now you would have realized, you would have seen over the last 1 month that funding is almost stalled at all places, and everyone is just thinking of survival now. As far as the startup industry, you would have seen a lot of people being hyped off. I think about the latest news that I saw was about 8,000 people being laid off from startups across the country. So the idea is that whenever you have a deficit as far as your cash balance is concerned, you will be left only with two options. Either you will have to get in more debt or you'll have to get in equity. Now the challenge with startups is that there's no collateral, so debt koi deta nahi hai. So that's why ab mere paas kuch option bacha nahi hai, so I have to raise equity and dilute. Whereas for, let's say, SME with land, building, any collateral which is available, or for other entities, if we have collaterals which are available, then you can go ahead with the debt options. In this case, simple scenario, since we have been given that if there's going to be a surplus, you can go and plug in repayments as far as long term and short term is concerned. I'm going to do the same over here. I will plug in repayments. I think 50 crores bola tha for long term. Let me see. So once I've plugged this 50 crores, two checks. First, balance sheet abhi bhi tallied hona chahiye. So that means that ensures that your model is taken care of. And second, your cash flows should still be positive. Okay. So 50 crore dene ke baad bhi cash flow still positive. So now we can go ahead and make the payment for the 25 crores as well. Same logic again, balance sheet should still tally and you should still have positive cash. Okay. And at that point in time, again, as I explained, you can go ahead and link it with whatever is your minimum requirement and check. So that's the entire summary with respect to how we will try and analyze whatever is surplus or whatever it is, or whenever there's a deficit. So I think we're done with two cases now, two full-fledged cases, one with service, another with manufacturing. I've also explained you all components with respect to financial modeling. So I hope that the basics with respect to how we'll be making your models from scratch, I think are pretty clear. I've also given you sources from where you can plug in data. Collation of data should be a cakewalk now. All right. So I think if I consider about almost 4 days that have gone, and I have about half an hour, which I'll be utilizing completely for valuation now. I hope the financial modeling bit is very, very clear. This is exactly similar to cycling or swimming. If you are going to believe that after 1 year you are going to open these files and you will try and maybe learn from it, again, you'll be investing a lot of time and energy. So if you are really interested in this practice line, practicing is very, very critical. Maybe start getting assignments, or even if you don't have assignments within this, maybe you can just pick up any company that you want. Start drawing down those models as well. All right. I hope the financial modeling bit is pretty clear. Moving forward, I'm closing this file for the time being. I hope everyone's got this. So all of you will be having the recording, so don't stress out on the files. Don't worry. Thanks. Right. Let's take a 30-second breather. Ma'am, all your recordings, everything will be shared. Don't worry, please. Yeah. For the next bit, let's take about a 30-second break, a quick break, and let's get back. Yeah. And in case if you can pull in a. Sorry, I'm getting another question. Any way to pull financial data in a clean way from manual reports, PDFs? So why would you refer to? So that's what I was explaining you last time also, right? You can just take subscriptions to stuff like Toffler, and these guys have provide you data in Excel directly, so you don't really have to worry about those data standpoints. All right. They have a plugin, and for private entities, it can get covered from Toffler. For listed entities, you anyways have all these free software which are available, whether it's Yahoo Finance or Money Control or whatever. You can just plug the Excel data from. Okay. Let's take 30 seconds off. If you can just get a cup of coffee for yourself, you don't have to do anything. It's going to be me talking for the next half an hour. You just have to listen. So just maybe get a cup of coffee to ensure that you're very much awake for the next 30 minutes. A very, very interesting topic. It's one topic that I love talking about. It's my bread and butter, which is valuations. See you in 30 seconds. Right. So the next 2.5 hours, 3 hours for the entire workshop or the series are going to be completely focused on the valuation side of things, and we'll get enough time. So any questions, queries that you have, we will do solve them tomorrow as well. So guys, all of you ready? Let's begin with valuation. Okay. So whenever we're starting touching base a new aspect, essentially I try and ask myself 3 questions, which is what, why, and how. And that's what we're going to be doing over here as well. So let's quickly try and understand what is valuation, why do we need valuation, and how do we actually do it. So the purpose of the next half an hour is to try and answer these 3 questions. Is anyone from WRC here? Is it possible to allow them to talk, allow the participants to talk, because I want to make this a little interactive?
I will check at my end, but I guess
that would be tough, right?
नितिन सर, आपको मैंने को-होस्ट बना दिया है, आप
So the participants can they are allowed to talk, right? If you can just allow them to talk, I think that's fine, because it's going to be more of an interactive session. आप उनको rights दे दीजिए. Thank you.
सर मैंने आपको राइट दे दिया सर.
But मुझे सबको देना पड़ेगा ना individually, right? Whenever.
सर सबको देना पड़ेगा, तो सबको सर आपको बोलने के लिए मतलब वहाँ पे राइट देना पड़ेगा, तो कौन बोलना चाहता है उसका हैंड बोलना पड़ेगा.
Okay, ठीक है, चलो. We'll figure this. No stress. You can maybe type in your queries in the chat box, and I'll keep it active over here.
or alternatively, people can raise their hand so that you can unmute them in future. Like Nitesh sir, I guess you got the right, and so like
Sure,
you
sure.
can,
Got it,
you
got
can
it.
unmute them.
Perfect. Thanks. So let's first factor in what is valuation, and then let's go back to basics in terms of forget what is valuation, what is value. So if you guys can keep on typing your answers. My first question is, what is value? Whatever comes to your mind from a layman perspective, if you can just type in what is value, please just, that would be great. Okay, so I'm getting various answers. Benefit, worth, market value of the product, company, something useful. All right, I'm getting another answer, which is price that you will give. Jigar sir is quoting price is what you pay, value is what you get. Fair price. Okay, and Amit sir has gone very, very technical, present value, future cash flows. Great. Okay, fantastic answers. So if I had to put this in a very, very lay terminology, then I am looking at value is nothing but worth. Okay, that one worth. And if I want to make it slightly more technical, I would use the word maybe economic or monetary right before the word worth. So essentially what we're looking at is nothing but the monetary worth or the economic worth of anything is value. It could be business, it could be an asset, it could be liability, whatever it is. It's the monetary or the economic worth. So I think that's clear. I think I got a lot of answers which said it's the price that you would want to pay. Okay. So maybe 2 aspects that I want to, bring your attention to is that value and price, 2 very, very different things. I'll just explain you with an example. Say for example, we are sitting in March 2020. Okay. And initial cases of COVID have just struck in. And let's say one elderly gentleman, unfortunately, has basically contracted the virus. And if you remember, during that point in time, hospitals were charging exorbitant rates because no one knew what this virus was, what the treatment was. And let's say that this elderly gentleman had to step into a hospital for a couple of days, and that resulted in a huge hospitalization bill. Now, unfortunately, to clear off the dues, this elderly gentleman had nothing but, let's say, a house property to his or her name. And this is what needed to be liquidated to ensure that the hospital gets its dues. Now, in a scenario like this, when this elderly gentleman had valued the property earlier prior to COVID, let's say that the value of this house property was about 1 crore. Obviously, on account of COVID, there was a lot of uncertainty. In a situation of uncertainty, no one makes very heavy purchases, which means that buyers are going to be lesser, which means that if demand is less, then the price also automatically goes down. So let's say that value correction happened during COVID, and the fair value of 1 crore maybe came down to, let's say, 90 lakhs. So now the value post COVID scenario for this particular house property is 90 lakhs. But the challenge is that this person has to liquidate this asset pretty much, as soon as possible, so that they can be clear of the dues. In a scenario like this, where you have to liquidate an asset, the advantage is always going to be with the buyer, because whatever buyer is going to be quoting, you would try and close the deal as fast as possible. Now, this can also be called as distress, or this can also be called as some amount of limitation at the end of the scenario. Now, because of this distress, there's a very high chance that this deal might not get consummated even at the fair value of 90 lakhs. Maybe the buyer will get a good deal out of this, and maybe the final transaction price could be 80 lakhs. All right. So there's a difference. The value was 90 lakhs, but the price at which the transaction got consummated was, let's say, 80, which basically tells you that value and price are not the same thing. Value and price can differ on account of external environment. It can differ on account of situations. It can differ on account of negotiating capabilities, so on and so forth. Okay. So one aspect which should be very, very clear for all of you is that value and price never the same. All right. Because if they were the same, the concept of goodwill or capital reserve will never come into play. Okay. Another thing that you need to remember is that value changes with time. All right. So again, I will use COVID scenario itself. If let's say you were a theater chain owner, and let's say COVID struck, and there's absolute uncertainty in terms of when the theater chains will start, showcasing cinemas or whatever. So say something like a PVR or Inox, huge amount of uncertainty. What happens to valuations at that point in time? Value goes down. But the minute there is a notification that theaters can open up, and maybe we are moving back to normalcy, masks are out in certain states, at that point in time, valuations could again go up. Something similar would have happened with the hotel industry also, where valuations would have gone down when the virus would have struck, and now since there's revenge tourism at play, so valuations again would have sold up. So two things that you have to remember: one, value is not the same as price, two very, very different things. And also value changes with time. Okay, is everyone clear with this? So this is the basic premise. I think I've got some people are raising their hands. Yes. So yes, Kusum ma'am, if you have any questions. Mahesh,
sorry, I don't have any questions.
Sure. Okay, great. Mahesh, if you have any questions. Okay. So this is basically what about the value bit, and obviously the process of arriving at the value is nothing but valuation. Why do we need it? Again, let's try and cover certain aspects. So regulatory pe to baad mein aayenge, but from a non-regulatory perspective, why would you need valuations? Chalo, let's see if you guys can answer it. Again, I'm just looking at the chat box for all your answers. If you can quickly answer. Why would you need valuations? I know there is the why is already there. Okay, explore synergies, go public, reinvestment. Okay, fabulous answers. Okay. Great, yeah, fantastic answers. So essentially, I'm just plugging this PPT, so I think that should cover all your aspects. Now, if I had to look at valuation as a stream, all right, prior to let's say 2017 or 2018, before the entire concept of registered valuer came in, and chartered accountants were doing most of the valuations in the country. So at that point in time, it was still, in fact, valuation as a domain is still very, very niche. I think it's still developing, and maybe the next decade would ideally belong to this profession. There's a lot of interest in this field. There are a lot of people who are joining the registered valuer course across the various RVOs that have been set up in the country. So the idea is that why suddenly valuations have become important is And there are two aspects to this. One aspect is that everyone's realized that, apart from a concern being, perpetually going ahead or moving with businesses, there's also scope of going down and exiting businesses and some other entity actually entering into those particular business domains. Also, as India moves up the ladder, we have second generation, third generation entrepreneurs. We will also need to go into succession planning. And that's where, whenever we get into succession planning, obviously something called as valuation will be very, very critical. So especially with the entire startup industry that has come into picture over the last couple of years, let's say a decade or so, a lot of people would have become first generation entrepreneurs. These first generation entrepreneurs would have seen a lot of wealth. And these guys eventually, when they'll be doing their own succession planning, will require a lot of valuation also. Apart from that, since the entire the perspective is changing, and maybe a lot of people are moving from jobs to businesses, and unfortunately, fortunately, whatever, there's always going to be difference of opinion, and whenever there's a difference of opinion, what it's going to lead to is a lot of disputes. Now, disputes is something which generally people avoid, but lawyers love. But there is also one aspect where valuers, people who are into financial modeling, will actually come into play. Is whenever there's any breach of contract, you'll be asked to ascertain the loss of profits from the breach or from the contract act perspective. And over there again, maybe valuations, computations, all of the financial modeling that we just did would essentially come into play. So dispute resolution is another field where I see within valuation a lot of traction that can come in. So I'm not only saying that valuation in itself is going to be a pretty big domain for the next decade, but even sub-domains within valuations, you will now see people specializing into disputes. You'll now see people specializing only into succession planning. You will see people specializing only with respect to SME valuations. You will see certain valuers only focused on startup valuations. So valuation per se as a domain has not only, has become popular, but for the next 10-15 years or so, maybe you will see all these fields also coming up. So again, various stuff from, let me just break it down into regulatory and non-regulatory perspective as far as valuation is concerned. Non-regulatory, again, all internal assessments prior to the deal making, understanding where I stand, taking all strategic decisions for the future, all of that will be covered within non-regulatory. Regulatory would be from all the perspectives, which is Companies Act, SEBI, which could be income tax, which could be FEMA, which could be RBI. All right. So all of these again would come in under regulatory. Again, so from a service standpoint, your regulatory business would ideally become your bread and butter business, and your non-regulatory business would essentially be the business where there'd be a lot of scenario building, a lot of scenario analysis. And I personally believe that non-regulatory valuations would require a lot more time, because you might have to, you might not even have a lot of data that's available, and so on and so forth. And it would be fun doing all these non-regulatory valuations, trying to ascertain what optimistic, pessimistic, moderate scenarios could be. So overall, I think these are your basic fundamentals with respect to why valuation is required. All your answers that you plugged into the chat box with respect to transactions, negotiations, all of that would come into play. Yeah, Shilpa ma'am, we'll give you the PPT. Don't worry. All record again. I'm saying all recordings will be shared with you. Don't worry about it. Okay? Now, why I think it's factored. Now, let's move to the most important part, which is how do we get to the valuation, which is very, very critical. Okay. Now, whenever I get to how do we get to the valuation bit, there are about 3 approaches which could be utilized for valuing the entity. And let me directly jump to those. Now, whichever part of the geography of India, or for that matter, anywhere in the world that you're sitting at, there are about 3 approaches which will help you arrive at value of any business, asset, or liability. Okay. And I'm going to start with one of those aspects, which is called as the market approach. Okay. Now, when we're talking about market approach, what we are essentially trying to do is we're trying to derive our value from, or derive the value of that business by comparing it with a similar business. Okay. So what I'm going to do is I'm going to give you a very small story. And I hope all of us will learn from that story, and we'll try and understand the entire approach, the entire market approach from that perspective. Okay. Now, let's say that, okay, sorry. So there are times when late evenings or weekends when I'm addressing seminars, webinars. So generally the point is that why I do this is to ensure that I interact with all of you. So there's a lot of learning that happens. But there's another reason why I genuinely do this. It's because if I am not addressing these webinars and seminars, then essentially what will happen is that I will have to end up playing a game of chess with my dad. And I have no issues with my dad. Neither do I have an issue with playing a game of chess. The challenge is that he's a better player, and I'll end up losing that game after a point in time. And when he's realized that that I'm just about to lose the game, the entire topic will get diverted to how difficult life was in their generation, all the amazing sacrifices that they've made, and they will eventually go and talk about their one leg was in, let's say, uh, uh, in very crazy waters, and they were still able to make it big in life. And all of us were born with silver spoons, and unfortunately have had it very easy. And to avoid all of these, I get into this. And while he's giving this thought process, how he generally starts is that he tries and values everything that he's built. So every Saturday or Sunday, if I'm actually having a discussion with him, I'll no, absolutely. I'm absolutely having fun with it. So the idea is that he tries and values every property, whether it's his office premises, whether it's house premises, all of that. So essentially what happens is every Saturday we are valuing house property. So while he's doing this, what's the best way then that he could do this is that he would ideally maybe log on to, let's say 99 acres or all these amazing portals which have come in, or he could or maybe look at the Reckner rates and stuff like that. But again, when universe has decided that it's going to be a session where you're going to be roasted, universe also plays along. And there is a paper called Times Property which has to come on a weekend only, unfortunately. And in that paper itself, there are all property prices area wise which are given, all right, for whichever city you are in. So he picks up that paper and he starts talking about that, all right. And alternatively, on days when he doesn't get that paper, what he does is he calls my mother. And because my mother has gone to the latest kitty party, which also has to happen over a weekend, as I said, when universe has decided that it's going to roast you, it will roast you. So and my father will try and figure out who has moved into the building premises or who's moved out of the premises, and my mother will help me figure that out. So essentially using that, he will try and value the house. So what he's trying to do is he'll try and see if there is any house property which is bought or sold in the immediate past, and he'll try and compare the prices, and he'll try and see what the transaction price was, what was the area of that house, and get to, let's say, a multiple which is called as, let's say, price per square feet. Bombay, essentially we generally use price per square feet for property, so I'll use that. Then what he'll do is he'll apply these prices or this particular multiple, as I call it, on the area of my house and get to a final valuation. That is nothing but the market approach of valuation. So whatever मैं जो भी story बोल रहा था, time pass नहीं कर रहा था, there was an entire logic to it. This entire process is market approach of valuation. Essentially what you're doing is that there are three aspects to market approach. First is whenever you're valuing something, identify peers or comparables. All right, that's number one. So if, let's say, you are valuing a house in your yeah, exactly. So whenever you are valuing a house property in a particular area, you might want to see the prices, or you might want to see houses in a similar area. So let's say if I want to take an example, let's say of there's a locality in Bombay which is called Juhu, which is a very prime location. And let's say there are three buildings lying in Juhu, one after the other. Two of those buildings belong to newer constructions. One, let's say, by a prominent builder, Oberoi, another by another builder, let's say Lodi. And the third one, which is a very old three-story structure in Juhu. So while you are picking up a comparable, you will never pick up a comparable which is in that third building, which is like a three-story, because it will not have all the amenities and facilities. You will end up comparing only Oberoi and Lodi because that is where all your facilities, amenities would be comparable, similar in nature. Similarly, while you are adopting market approach, the first thing that you should do, let's say now, let's get back to valuing businesses. Let's say you're trying to value, I think steel is in news right now with respect to all the duties. Let's say you're trying to value Tata Steel. So if you're trying to value Tata Steel, the first thing that you will need is comparable companies. Now, what would be comparable companies for Tata Steel in India? Quickly, if you can just type it in the chat box. Right. So we essentially have two comparables. So we have JSW. So Jindal Steel, I think, would have power also. It's JSPR. So overall, if I had to look at comparables, almost like apple to apple comparables, then JSW and SAIL, I think would be apple to apple comparables, given the fact that all three of them are primary producers of steel. Now, once I take these entities into account, that will be my starting point, which is identifying comparables. My next step in market approach would be identifying multiples. Like in the case of a house property, how we identified that price per square feet would be a multiple. In a similar situation, while you're valuing businesses, you might want to take certain financial indicators. The traditional indicators which are used in businesses are EV sales, EV EBITDA, price to earnings, price to book. These four are the traditional multiples that are generally used. And then now for startups and for newer age businesses, we have contemporary multiples. So let's say if I'm doing a taxi aggregation business, I might have EV by number of taxi or the fleet that we have. Or if I'm doing a social networking website, then I might have EV by active users that website has. So again, a lot of contemporary multiples. The idea with contemporary multiples are the underlying should be the most important factor to the business. Similarly, let's say if I was doing a hotels business or if I was doing a hospital business, then I could have multiples like EV by hospital beds or EV by number of hotel rooms, because those are my key business drivers. Right. So step 2, identify multiples, and step 3 is adopting that multiple and applying it on your own parameters. So let's say if we figured out something, a ratio called as PE ratio for JSW and SAIL, and let's say that the PE ratio, average PE ratio for both comes to about 20. And we also know what is the profitability of Tata Steel. 20 multiplied by profitability of Tata Steel will get you to valuation of Tata Steel. That's the logic. All right. So I hope you guys will remember 3 things which are very, very critical. I'm writing it down as well. So we've got market approach. 3 things which are critical. First is identify comparables. Second is identify multiples. I know screen is not shared. I'm just talking to you guys. There's nothing on the screen. All right. So there's identify comparables. Second is identify multiples. And last, adopt multiples. Okay. So these are 3 important aspects with respect to market approach. There are 2 methodologies within market approach, which is comparable companies and comparable transactions. Correct. In valuation parlance, they are generally called as CCM and CTM. What you do under comparable companies is exactly the process that I explained for, let's say, valuing a company like Tata Steel. So that's there on your screen right now. Okay, so you'll identify comparable companies, but remember the most important point over here is which are traded on stock exchanges. Okay, so the difference between comparable companies and comparable transactions would be that while you're applying comparable companies methodologies, your comparables would be listed on stock exchanges. While you're doing comparable transactions, they may or may not be listed on stock exchanges. Okay, so say, to give you an example, if you're trying to value Flipkart in India, there is no real comparable which is actually listed as far as the market aggregator is concerned in India, or at least it wasn't. Now we at least have one, which is, let's say, Nykaa, but Nykaa again has a very, very different model. It works on an inventory model, so might not be a comparable also. So let's say if I wanted to actually get to valuation of Flipkart, I would want to value Amazon India, per se, the business in India. But unfortunately, Amazon India is not listed. So what I'll have to do is I might have to see whether the private entity, which is the Amazon India entity, and what are the recent investments which have happened, what is the valuation that has happened with respect to that. And then from there, I will have to take multiples and try and value Flipkart India. So comparable companies is a method which you will be able to use if your comparables are listed. Comparable transactions, you'll be able to use whether they are listed or not. You'll have to study the transactions with respect to those those comparables or those pairs. Okay. Now the only challenge with the difference or the challenge with respect to data is that comparable transactions, although you might be able to read them on Google and you might be able to see, availability of data is a very, very major concern. As far as CCM is concerned, availability of data is not a challenge because all of these are listed entities. So you will be able to get to those. It is difficult to get to EV for unlisted companies as compliance filing. There's only value per share information. Yeah, but ma'am, if you have value per share, you just multiply, and also you can get the valuation report. You can always download the valuation report from ROC filings. So that will have your value per share. You'll have number of shares, multiply, and you'll get your total valuation. And also, if you really want to get these information, you can subscribe to a lot of software which are available. Okay. So market approach, in any sense, what we're trying to say is that within market approach, we are going to be relying on our peers or comparables, and on the basis of whatever is their valuation, we'll try and derive our valuation. That is why it is also called as relative valuation, because you're trying to relate to someone else's value. Under income approach, what you're doing is that you are trying to forecast. So as there were three things which are important under market approach, there are three things which are important under income approach also. Three things which are important under income approach are: first, projections; second, discounting factor; and third, the terminal growth rate. All right. So essentially, first you will require projections if you have to apply income approach. Projections is something that we covered very extensively over the last 3.5 days. The next thing that you will have to factor in is what is the discount rate at which you want to discount these cash flows back to the present value. And third, if you believe that this firm is going to have, it's going to be a going concern, and in that case, what's the stable growth rate at which this is expected to grow. Keeping all those factors into combined, there are two methodologies that are most generally used while using the income approach, which is FCFF and FCFE. FCFE stands for free cash flows to firm, and FCFE stands for free cash flows to firm. Now, whatever methodologies that we've spoken, whether income or market, for both FCFF, FCFE, and CCM and CTM, we'll be doing illustrations tomorrow. And lastly, coming down to cost approach. Cost approach, basically what you're looking at is you're trying to say that if I had to build this entire business again back from scratch, then what's the amount of investment that would go in? So again, it's a little narrow as far as the approach is concerned, because it's just looking at it from the lens that what would be the cost that would go in. But if I was trying to value a service company using a cost approach, it could be very, very challenging because it's not taking the future potential into account. So you would see that 80-85% of the times maybe cost approach becomes redundant. Cost approach actually comes into play where there's a huge amount of investment that has happened, or something like real estate can come into play and stuff like that. Okay. So three approaches: how to apply, what approach to apply, where to apply, how to actually calculate all of these methodologies. We'll be covering all of that in tomorrow's session. All right. I hope you guys, yeah, I'll be explaining all of this. So what is FCFF? What's the difference between FCFF, FCFE? So I'll give it to you right away. FCFF essentially stands for free cash flows to firm. So you're trying to derive cash flows for both your equity stakeholders as well as your debt stakeholders with whatever name that you have. Whereas for FCFE, it's only cash flows with respect to equity. The logic is eventually using both methods, you're trying to arrive at the same answer, which is the value of equity, which is what we'll do tomorrow. So I think you'll have a clear perspective. So tomorrow's session is going to be focused. I'll tell you what we're doing tomorrow as well. Is going to be focused on two illustrations. Both these illustrations will, so one illustration which will be based on income approach, which will cover FCFF and FCFE. It will also cover things like sensitivity and so on. Man, there are no less costly software. All softwares will cost more than 1 lakh, 2 lakhs, 3 lakhs. So because these guys are also collating a lot of data, so they're not going to give you at a very cheap price. So you can always refer to, I think we have something called as venture intelligence, so VCCH, or you could just log on to maybe Capital IQ. Again, these softwares are going to be expensive, unfortunately, because there's a lot of data that comes along with it. Okay, now how to get comparable data for foreign companies? Yahoo Finance, that's your answer. Yahoo Finance has everything that's available. So yeah. Now coming to what we are covering tomorrow. So two illustrations, one on income and the other one on market. and we'll also be covering certain aspects as sensitivity analysis and so on and so forth. Looking forward for tomorrow's session. I hope you guys had some validation today, and I hope that you'll have a lot of validation tomorrow. Right. Please don't miss out on tomorrow's session. It's going to be a fun session, and I'll be sharing all the illustrations before the class. Yeah. Yogesh, can we bring the day to the close, please?
Yeah, we can wrap it up right now. So it was a wonderful session. So we will see you all tomorrow for the last day of the session. See you, sir.